What is going on, everybody? Thanks for checking into our TDR Small Cap Sunday podcast. Hope you all had a great weekend, as tonight we unveil 4 new small cap stocks that may be of interest to you. We call this the 100% Growth Show. Why? Well, we look at companies that have had extensive growth, and really, when you look on it from the outside looking in, you think, yes, these are stocks that definitely should grab your interest. But there's more to it than just looking at the overall growth. What is it? Some interesting things that we plan to share here tonight. So let's welcome in TDR lead financial analyst Bill McNarland. Happy Sunday. Good to see you.
Yeah. How are you doing?
I am good. So the 100% Growth Show is the idea that you came up with this week, but there's more that meets the eye. And I know you're going to get into that with some of the stocks that we unveil here this evening, right?
Yeah. It'll be interesting to see. I think, some people would be of the belief that if a company is growing super fast, maybe they've
Right.
grown their revenue by 3, 4, 500% over 3 years, their stock should be up 3, 4, 500% too. So let's just look into this and see what we can find out. Obviously,
So
growth is a great thing.
So why, like, and that's just a generic conversation, but what are some things to look for, to be aware of, that if the stock's not up that much because the growth is, what's missing? What's the the disconnect, so to speak?
Yeah, I think the point is that there's more important things than just revenue because eventually profitability becomes thing. And
Yep.
the other thing too is you don't necessarily need revenue growth to grow earnings. And I'll give you an example. This year we have record stock buybacks. So if you're a mature company and you do not grow your earnings, but you reduce your share count by 5%, your earnings go up by 5%.
Of
So
course.
there's a lot more to see. It's also how much your share count. So it's not just the revenue growth. We have to look deeper, and we're going to find out about that. It'll cause some conversation today about that.
It's a common question that gets brought up a lot in the cannabis space. I know that because their stocks have been hit hard. And that's obviously a vertical that we cover a lot of, but always get that question from time to time for a lot of reviewers regarding specific stocks. So there's going to be share buybacks by a lot of the executive team. But let's get into it. Before we do, as usual, all views on the Small Cap Sunday podcast and the guests on this podcast are purely opinion. You should not treat any opinions expressed by us or guests as investment advice. And the views on this podcast are solely intended to be informational and are not investment advice. Okay, let's begin with our first company, which is a retail business. It's called Direct Digital Holdings, trades on the NASDAQ under the ticker symbol DRCT, located in the Lone Star State in Houston. Current share price $2.95, market cap 43 million, shares outstanding 18 million, daily trading volume 269,000, and looking at their 52-week range, wow, between $1.85 and $35.88, Bill. What's this story?
Yeah, so this has been a bit of a bumpy ride. So first of all, this is an area that's fast growing in industry, advertising spending for online sources. And this company comes to businesses and helps them out with their spendings. They're professionals. They give
Yep.
them lots of options to spend on. And everyone's going to long term increase their spending, but how to do it is a head scratcher to everyone. And so they
Yep.
have the sophistication to help people. The other thing that's very popular about the company, it has a lot of followers because it has a very high rate of diversity in the employee group. And so they're very proud of that. And that's an area that investors are looking for now. So they had an IPO in 2022. The stock came out at the same price as trading at now, but it's been all over the map.
Yeah, no kidding.
Yeah.
So as you said, IPO'd in 2022. They have over 228 clients. They're a multi-service platform that helps companies, as you said, advertise across a wide range of digital channels and generate around 400 billion impressions per month, which is big. So how, in your own words, do they plan to expand further from where they are right now?
They're just going to keep on doing what they're doing and getting better. And we'll look at the numbers in a bit, but their revenue growth has been fantastic. So I believe the core of the business on first glance makes a lot of sense. But the stock volatility this year, they had a huge run up after their IPO, but they had a challenge. They had some issues with their auditor.
Hmm.
Now so the first thing I look at when I hear there's an audit problem with a company, I'm like, well, you got to look deeply at this. The first issue is they were using a small regional auditor. And there's an accounting crisis going on in the US right now. It's very hard to get an auditor, it's very hard for them to keep employees. So there was a big delay in getting their financials out, but they upgraded. They went to BDO, top 5 auditor in the world, and
Yep.
now everything's in order financially and all their statements are up to date. If you have a big problem with your company, you can't upgrade auditors. You can only downgrade. So they upgraded. So that's a good news situation. And also, it found out you can read documents and find out more about why that have to be disclosed. So this is interesting. Everything's been sorted out, but the stock is still really down since that announcement about their accounting challenges.
Well, when I first started this company, somebody said, when you get big, make sure you hire a CFO as your first hire, a very good one. And that is definitely the case, I would think, for corporations like this. Okay, let's go to the charts right now. Look at revenue over the past 12 months, along with growth percentage. What did we find here?
So 27% growth over the last year, which is much higher than what the industry on ad
Yep.
spend is growing, but 132% over the last 3 years. So that's a year. So that's just fantastic. They've just been hitting it out of the park.
Gross margin came in a little over 22%, if I'm correct.
Yeah, but their SG&A spend is also just over 22%. So you can see with a fast growing company, you got to watch. So they're here, they're at the point where they're just moving into getting those numbers to make sense.
Yep.
And this is a turning point of a company when you can see that happen. So this gets interesting to me. We'll look at the rest of the numbers. You can see that they have a negative EBITDA of 7 million, but eventually your growth gets to the point that your SG&A stops growing, your margins grow a little bit, and then your revenue grows, and then you turn into profitability. So on first glance, this is a pretty interesting time frame for the company.
Okay. EBITDA is what?
Minus 7 million. So with more growth and keeping SGA in check, this should be around the time in the next year that they turn into positive EBITDA.
Okay. Let's now shift to balance sheet. Current cash position and working capital is showing what?
Yeah, it's about $1 million. Their working capital is 5 million. So this is the time that they have to turn into the profitability, or they would have to either borrow or they would have to raise a different some equity. But this is what you want to look at, these fast growing companies. You want to make sure that in the next year or a short period of time that they have a real plan for profitability. And if
Yeah.
you see a huge spread between SG&A, it's really high and the margins aren't there, it's not going to happen. But these two numbers are very close, so it seems very reasonable that this company can go into profitability.
So, how much do you think AI is going to play a factor when it comes to people purchasing advertising moving forward? Because if you get rid of the middle person, meaning the account executive, and you're able to buy, let's say, whatever, any kind of advertising through television, those sorts of things, are these all going to be done through software platforms?
I think it's going to, there still needs to be a strategic plan and there still needs a group to help you. And then I think AI becomes the helper to make it more efficient. So I don't think a company like this is going to disappear with AI. There still needs to be quality support in putting together a plan for how to use AI with the spending. And that's reflective that their continued growth rate during this time of AI is still very strong in the last 12 months.
Yeah, no kidding. AI is going to be effective, but it's going to be a while before people truly understand how to work and work it properly. Okay, let's now look at levered free cash flow. What did it show?
And the last 2 years was down 3 million on average over the last 2 years. So that's in line with where we saw with their EBITDA. Their EBITDA was actually -7, so this is encouraging that leverage free cash flow was less. So this looks like it's at the time that a fast growing company can get someone's attention, and you're not worried about being diluted as a shareholder.
Okay, moment of truth time. Would you own this stock?
I like the idea. I like the industry. I like what the company's doing. I love after there's poor news that gets solved. I think that's an interesting entrance point because you got a lot more growth since their IPO. They worked out this issue. This could get exciting again. So this is something I would own as a company.
Transparency is everything, is it not?
Yeah.
All right. First green check mark. Direct Digital, trades on the NASDAQ under the ticker symbol DRCT. All right. Company number 2 is a biotech service provider. It's a company called Inotiv Incorporated. Trades on the NASDAQ under the ticker symbol NOTV out of Lafayette, Indiana. Current share price $1.72. Market cap 44 million. Shares outstanding 26 million. Daily trading volume, big, 21 million, and 52-week range is from $1.23 to $11.42. So again, extremely volatile, Bill. So what's the story here?
So biotech naturally is volatile. When I'm looking at biotech, I still want companies that there's the potential for revenue soon, or there is revenue, or some other involvement. And what I like about this company is it kind of reminds me of the gold days, that people would move up to far regions to try to get rich, and who got rich was actually the grocery store that was selling, or the general store that was selling the shovels and the supplies.
Yeah,
And so when you're doing a scientific study and you're a biotech, when you're going through the phases of trials, you better not mess up. And this is hard to do internally. And so you can outsource some of those services to get it done with an expert in the field. And so this is what this company does. It offers their services to biotech companies to be able to properly go through their trials, and to be successful.
which is badly needed for sure, especially as you see all these emerging medicine companies going public and really trying to conduct their trials in the right format, which I've seen a lot of. There was a few other small cap companies that we've covered in the past that kind of fit that narrative. Why the reason? This is big trading volume, 21 million on average. That's huge.
This was a darling of the capital markets, especially the end of 2021. The stock was trading just under $60, so now it's a $1.72. We'll take a
Wow.
look at their financials, but they had a hiccup that's been solved, similar to the company we looked at earlier this evening.
Yeah.
So there was an investigation around some controversy about their how they made use of animals.
Here we
There
go.
was an investigation, a federal investigation. This isn't something that's not looked at, um, and there was confirmation that the investigation has ended.
Hmm.
So that's a tough news story, and that takes a little while to sort
No
out.
way getting around that. And the only thing that's going to solve that is time, right?
Yeah, that's time. And also there's certain investors that they don't want to invest in. Maybe if someone has a belief of being a vegan, wouldn't want to invest in a company like this. So when that comes out, different people have, maybe people weren't aware that animals were used at all. And so this takes some time to work out. But as a company, if they keep performing well in the future, typically these things get forgotten through time.
Well, a lot of trials do begin with animals, do they not?
Yeah, they do. And eventually people will go back to have quarter pounders with cheese at McDonald's too, right?
Very good point. Very good point. We live in a strange world, don't we?
Yeah.
All right, let's go to the charts. Revenue, past 12 months, along with growth percentage. Again, showing what?
So the revenue dipped. The last 12 months was down 14%. And you can see, being in the news is hard on business development. So that seems a natural fit. But their 3-year growth rate of revenue has been 111%.
Yeah,
So their revenue is 501 million last 12 months. So it's not like they started at a million and went to 2 million and doubled.
right.
They've done something really significant here. And when we'll take a look at the margins here, this is significant.
Gross margins, 22.6%. So impressive to say the least.
Yeah, and their SG&A is only 10, so it's not a surprise. They have 20 million of EBITDA in the last 12 months, but their
Wow.
market cap's only 44 million.
So walk us through the simple math when you're looking at something like that. Gross margin 22.6%, SG&A came in at 10.5%, EBITDA 20 million, which is impressive. Then a market cap, as you said, was 44 million. So when you look at
Yeah.
that, how are you what grabs your attention at first? Obviously EBITDA, and then, well, pretty self-explanatory, gross margin, and then you're basically spending half of that in SG&A. But that's why is it only $44 million market cap?
Well, I think it's the controversy with the animals is still the hangover, but the 501 million of revenue really gets my attention too. That's a lot of selling picks and shovels, and it takes a long time. Like you're not. I'll put a stab out there. I can't prove this point, but I suspect that I'm not going to find any other business that's in biotech at $44 million of market cap that has 500 million of revenue.
Yeah, no
It's just
kidding.
huge, right? So that they've had. This is another thing. I look at this and say, okay, is the controversy over? And I did the research, and there's a press release there that the investigation's ending. So this is interesting when you see companies like this that have the growth. Maybe they've had a hiccup, but within time, you think to yourself, is that going to work out?
Do some of these people that work with these service providers, do you think have experience working with the FDA at some point? Because, if you have that, I look at some of these psychedelic companies and some of their chief medical officers do have FDA backgrounds. And those are the companies I think you want to pay attention to and how to craft and package a lot of these trials together. But This is a service provider. They're not companies that are trying to basically exercise drug development, which we all know is high stakes and is very expensive. But interesting to see what kind of background these service providers and some of the people that work within these companies and what their history and background would be.
Yeah, and the point is when they're in the sales process, they just want to have more experience than the people at the biotech company feel that they have internally. And
Yeah.
so they convince the people to outsource it. And
Yeah.
you see this, it kind of reminds me some ways in a lawyer shop. There's a lot of fees if you're a public company and you want to go public or whatever. There's a lot of fees that go to the lawyer companies and the lawyers doing your public offerings. And similar to this, you're going through all these phases. You need help on the medical side, and so they proved this out with 500 million of revenue that's been growing significantly over the last 3 years. That biotech companies need their help.
So for companies to do this, is it a lot cheaper to hire a service provider versus hire internally?
Similar to anything, it's like having your own in-house legal counsel compared to going outsource. The
Yeah,
cost is going to be higher to go out, but the goal is that you're just getting higher expertise, and your chance of being successful
or
is better.
greater.
Yeah,
So allocate your money wisely, right?
yeah.
All right, let's look at cash flow statements. Levered free cash flow came in at what?
Yeah, they were at minus $8 million because they had a lot of capital expenditures where they were expanding, but their operating cash flow, the cash flow they made from the spread between their gross margin and SG&A, was $14 million, and so they decided to invest that in expanding their locations and the areas that they have, and so that's something that should come back in future revenue growth.
Makes sense. I was going to ask if they're making 501 million in revenue, where is all that money going with the current cash position of 14 million? But as you said, trials and locations is not cheap, but you need to expand and get larger trial sizes. All right, moment of truth. Would you own this stock?
I would, I just love the history of pick and shovel businesses in the last 150 years of the capital markets.
Yeah.
Being the service provider in an area that's growing quickly is an intriguing spot to be in.
Okay. All right, now time for our third company. We covered a biotech service provider, and we're going to keep on the same narrative. It's a biotech company. It's called Spero Therapeutics, trades on the NASDAQ under the ticker symbol SPRO, located Boston, Massachusetts. Great city, to say the least. Current share price, $1.28. Market cap, 69 million. Shares outstanding, 54 million. Daily trading volume, 161,000, and the 52-week range is ranging anywhere between 99 cents and $1.89. All right, let's continue on this same category. We talked about a service provider. This is a biotech company, Bill. What grabbed your interest pertaining to this company?
So this is a biotech company, and as a biotech company, you have one choice that we don't see too often is when you have some approved drugs, you can go do a partnership with a very large pharmaceutical company, and you will do a royalty sharing agreement based on where that you're at, and you can even get this sometimes in phase 3, for example. And this is what this company did. They went out to GlaxoSmithKline in a
Okay.
partnership, and they got large checks for doing this, and large checks in the future for doing this. But investors sometimes are unusual. Sometimes they don't like these arrangements.
Why
They'd
is
rather
that?
say, "Oh, shoot for the stars. Go at it yourself." In a way, it's kind of hedging your risks. You
Okay.
partner with a group, you take some money, you could have done better. And then with biotech companies, they're all over the map with excitements. They can move really quickly and they can
Oh,
calm
yeah.
down based on investors' interests. And so I looked at this stock chart and I saw, okay, the stock is trading near closer to its 52 reach range low, but it's down since during COVID. It was really up there. Then I said, well, how come a company with an agreement like this is down so much?
Yeah.
And so I did some reading and found out some investors they're not impressed with the agreements. And some people thought it would take away from the potential of going to the moon. Um, but I became intrigued, and I said, "Well, I want to dig deeper into this and see what their financials look with these payments that have been coming in."
So their approach with GlaxoSmithKline is being part of something is better than having all of nothing, I assume, correct?
Yeah, yeah. And so, being at my age, that I find that attractive.
Yeah, no kidding, right?
I don't know. So it was interesting to look
I've
at.
learned that lesson the last 4 years. Man, oh man, at the small cap space, we've been hit hard. Okay, so we get an idea as how they generate revenue. So can maybe you explain a little bit more on how these milestone payments are and how royalties would work in the biotech field?
Yeah, so these can be negotiated hundreds of different ways. It just depends at the table how it's done. So sometimes there can be the agreement can be for life. There can be for a certain period. Sometimes the payments are fronted up. And this company did an agreement where they got a certain amount of an upfront payment of 66 million. There was $9 million of stock that was purchased, and then they were eligible for up to $400 million of additional royalties as well. And this gives them money so that they can continue also to invest in other opportunities that they have in their pipeline. So it's
Gotcha.
kind of hedging your risks, and it's a form of a non-dilutive funding.
Yeah. Hedging your risk is definitely something that always has to be at the forefront in the biotech field. All right, let's go. It's chart time. Let's look at revenue over the past 12 months. And again, their growth percentages showing what?
Well, it's huge. They got $118 million of revenue and a huge growth, 118% last year, 123% over the last 3 years. Now, a lot of that is because of the payments that they're getting. Some of the payments earlier are larger. So that gave them a very nice looking gross margin and SG&A. So it's trading very inexpensively compared to those payments. So that
37% gross margin. Wow.
yeah, and so then and they had 21 million of EBITDA, but are only trading for $69 million.
Hmm.
So that's interesting, and this is a real payee that they Glasgow Smith Kline is not a silly group of individuals.
No.
They have confidence in them. But what's interesting, we'll look at in a minute. We start to go through what are they using that cash floor. So that becomes very interesting to see.
Do you know
Is it going back in R&D or such?
what are they focusing on trial wise? Do you know?
Yeah, so they have a lot of stuff that was focused on urinary tract infections.
Okay. Which is huge. What's the
Yeah,
total addressable market for something like that? That would
I
be
don't have it
massive.
here, but I know it's common. We all talk about it so easily. We're familiar with it, so it's a huge addressable market.
Okay. Let's move now to the balance sheet. Current cash position is showing 63 million and working capital is 60, if I'm correct.
Yeah, so they still have lots of cash from this transaction, and they have positive EBITDA as we saw. So the balance sheet is in very strong shape.
Anytime that you can partner with a household brand like that to help offset costs, just the association alone would have some sort of investor confidence, would it not?
Absolutely, but it's such a confidence boost because the due diligence to get to an agreement like this with a large player like that is
Yeah.
huge. It's a big vote of confidence. And also, they just didn't give money for the agreement. They agreed to buy shares as well. And that's why their balance sheet looks strong because GSK is an equity investor in the company as well.
That's more than half the battle is like, yes, you want to hedge your risks, but at the same time, too, what you're doing has to work and has to be done effectively to obviously attract someone like that within your portfolio if you're moving forward, like GlaxoSmithKline. All right, let's look at cash flow situation. Levered free cash flow showed what?
You can see that they're managing this responsibly. So it was minus $1 million over the last 2 years. Their R&D spending was 74 million last year, which is more than their market cap. GlaxoSmithKline and myself or yourself probably likely think that probably that $74 million is going to lead to something more in the future. So
Well,
they're
why?
heavily investing in this. They have the cash to do it from a very smart investor.
This one's grabbed my attention. That's a huge name. And to dish out that kind of money, what phase are they in? What trial? Do you know what phase
They
they're
have
in as far as trials?
multiple. Yeah, they have multiple products in different phases, and then
Do you know which
uh,
one's furthest along within their pipeline or no?
yeah, I don't have it off, but I think the UTI is in production now. They're actually out selling it, and it's helping people with their UTIs.
All right. This is an interesting one. All right. Moment of truth. Would you own this stock? And I think you're going to get a big fat green check mark on this one.
Yeah, because it's biotech. Biotech is risky, but this is de-risked, and to me, it has there's some confidence, added confidence going along with a company like GSK.
All right, so we got 3 green check marks here tonight. Spero Therapeutics, hopefully I'm pronouncing that correctly, trades on the NASDAQ under the ticker symbol SPRO. All right, it's now time for our fourth and final company here this evening. It is a manufacturing company called XOS Incorporated, trades on the NASDAQ under the ticker symbol of XOS. They're actually located in Los Angeles. Current share price $4.86. Market cap 69 million. Shares outstanding 15 million. Daily trading volume 83,000, and 52-week range is $4.40 to $15. So, Bill and I look at this. This is almost at the 52-week low. So, we've always talked about in the small cap space, are things on sale or is this a trap? What'd you find?
Yeah, so the stock's down 98% since the last few years, last 3 years since it came out in an IPO in 2021.
Okay.
There's a big problem. We know the last mile with a delivery is a huge problem.
Okay.
These days you can order some $5 worth of tea, and as we know, it gets to your house. Yet, it costs $20 to go across town in an Uber or cab. Yet your $5 tea comes for free, right? After it got off the cargo plane from his last night flight, so that they come with a solution. They're like, okay, we can take care of your last mile, and no problem. We'll do it more efficiently for you with our vehicles. And the big great news is they're electric and there's charging stations. And so you can see where investors got excited about this. Is like, wow, they're solving the last mile, and it's also electric. It's good for the environment. A big exciting story, right? So we'll take a look at how that worked out financially for them.
So it's something I wasn't even aware of that, but it makes sense. That last mile, when you just outline and provide an example, like is that always, I guess, a major issue for a lot of companies, and like when it comes to the overall quality of a product?
It's the most challenging part because you see how big trains are going
Yep.
from a port to a major city. Everything's on there. Sorting it out, putting it on a truck to drive around in a neighborhood and getting it delivered is the worst problem when you want to get into the business of delivery. And so they potentially had a solution here, and it's also good for the environment. So people got
Okay.
very excited.
So they're based in Los Angeles. Are they located like do they have a fleet of vehicles all across the country?
Well, they're trying to sell you a vehicle and sell you the services across the country
Gotcha.
so that
Gotcha.
you can do it yourself more efficiently with their support.
Yeah. Interesting to say the least, but yeah, I can understand why people with regards to complementing and making the environment better, that is a huge footprint and a huge priority for a lot of publicly traded companies moving forward into 2025 and beyond. Okay. Current challenges at all, like charging stations. Do we have an idea as to like how much charging stations have expanded across the country?
They're expanding, and this company is on our show because they're expanding very quickly, and they have charging stations and they have the infrastructure for it for you to use. And we know they're on the show for their sales growth. So this is expanding a great area. It's exciting. It's a problem. There's a solution, and this company is high growth. It's not just a dream.
Is there much competition? Because it's not something I hear all that often. And with regards to
No,
like,
no.
no,
These big trucks, like they're just similar to there's some people selling electric cars like Tesla and such, and they have a few
yep.
competitors. In the larger area, there's not a lot of competition.
All right, so this has got huge growth. Let's look at the charts now and look at their financial income statements. All right, first up, revenue past 12 months along with growth percentage showed what?
120% over the year, 156% compounding over the last three. So they have real revenue, $63 million. They did this well. They grew their revenue, and this is what investors were expecting. But we have to go a little farther down to see why their stock is down.
I feel like there's a but here. EBITDA
Yeah,
minus 42 million. What happened?
yeah, because their gross margins 12%, yet their costs are 62% in SG&A, and so their
How does that
margins are
work?
just
Yeah, why where is like gross margin compared to obviously SG&A? They're obviously trying to expand their fleet across the country. Is that the main reason?
well. They're selling to you. So just like you walking into a car dealership buying a new truck, they're trying to get you excited about that truck. That's SG&A, and the money
Correct.
they make off the truck is their gross margin. There's
Mhm.
not a lot of margin in solving this problem.
No.
So this is a fundamental problem when you have a fast growing company that's not built for margins.
We need margins, bud. Balance sheet, current cash position is what?
They have cash at 20 million, market cap of 38, but that's going to disappear pretty quick because they have working capital of 10 million, but they had loss of EBITDA of minus 42 million last year. So this is a problem. It looks, based on that, it looks like they have a big problem 3-4 months from now.
Yeah. That'd be a tough sell, would it not?
Yeah,
Like,
so they could dilute, they can, potentially raise some money, sell some royalties, but the investor is going to get less.
yeah. There was a company we actually covered in our early days called Ojo Scooters, and they basically were trying to lock in contracts with every city across the country. The reality is that you get into some of these colder cities and scooters are just not viable, 6 months out of the year. But you go to some of these other southern cities and they're everywhere, and it does make sense. But tough sell to say the least. Oh, working capital showed what again? Sorry.
Yeah, so the working capital is 10 million, and they had losses of $42 million of EBITDA last year. So, and they don't have a lot of cash to support that burn.
All right. So, moment of truth time. I think we're getting our first red X mark here this evening, correct?
Yeah, it's a big problem. They saw a problem and they have the revenue. The customers want it, but you have to build your company for margin. You just can't be focused on the problem and the solution.
So, how do you fix that?
You got to focus first on building a business that you're solving your shareholders' problem first, which is making money, right? And so it's not just about solving the customer. So there has to be a balance between the customer and what profit you're making for shareholders. And this plan isn't working.
Got to make your margins bigger. That's for sure.
Yep.
All right. So we got 3 green check marks, 1 red X. Direct Digital in the NASDAQ, ticker symbol DRCT. That was a green check mark. Inotiv, hopefully I'm pronouncing that correctly, Incorporated, trades the NASDAQ. NOTV, another green check mark. Spero, Therapeutics, what a find that was on the NASDAQ. SPRO, green check mark. And then our final one, based out of Los Angeles. XOS Incorporated, focuses on electric motor vehicles. That is our first and only red X here this evening. So, again, I want to get some comments, give some feedback to the man, Bill McNarland, for all the research that he's done and some of the ideas that he provides. Do you agree? Do you disagree? Do you like some of the approaches these companies are making? We'd love to hear from you, so leave some comments below. Bill, as usual, always great catching up with you, and we'll see you next week.
Excellent. Yeah. Take care.
Take care. Hey, everyone. Thanks again for watching. Hey, we're humming along, and it's all because of you and the audience and community that we're building. So, again, make sure to smash on that like button and leave lots of comments. Who do we have up next? You let us know. Who should we interview? What companies? Is there anything you like? Is there anything we're missing? We're all here for you. Let's get on with each other and build this community for all of us to benefit. As usual, don't forget to subscribe to our channel because in the end, we wouldn't be here without you. Thanks again, everyone.